India is completely rewiring its power grid. That massive infrastructure push has triggered a transmission upcycle that recently handed investors in one specific equipment manufacturer a staggering 138% return in a single year. That company is GE Vernova T&D India. They are a pure-play 1.4 lakh crore rupee heavyweight, sitting right at the center of this national transition. This infographic maps the high-voltage direct current, or HVDC, opportunity pipeline. The macro tailwinds here are massive. The country is targeting 100 gigawatts of nuclear capacity, and that power requires a multi-billion-dollar build-out of new transmission infrastructure just to reach the grid. The long-term runway is very clearly defined. By the 2028 to 2030 period, the market size is projected to double compared to where we were just 2 years ago. But then we look at the price tag. You are looking at a price-to-earnings ratio of 114 and a price-to-book ratio of nearly 68. The market has priced in a massive order book, leaving absolutely zero margin of safety. We have to figure out if this level of execution guarantees a multibagger for the next 5 years, or if buying at these multiples is a retail trap, where a single delayed project means heavy losses. GE Vernova T&D operates as a high-tech monopoly in the power sector, having pioneered the 765 kV AC and 800 kV HVDC technology that now defines India's national grid. This flowchart maps the energy journey from generation to the end user. Notice where they secure their revenue. They sit right in the bottleneck, managing the transfer, the orchestration of digital power systems, and the conversion of power to keep the grid stable. Focusing on these complex, high-value HVDC projects, like the recent Kavda South contract, has allowed them to stockpile an enormous 260 billion rupee forward order book. To meet that backlog, they are deploying 9.2 billion rupees in internal capital to expand their manufacturing lines in Vadodara, Hosur, and Patapai. That is the core business trade-off here. They have locked in complete revenue visibility for the next 3 to 4 years. But if the supply chain stalls or project execution slows down, their working capital gets trapped, and that pristine growth narrative cracks. This financial scorecard compares actuals against projections. Revenue is expected to scale from 31.6 thousand million rupees in FY24 to a projected 1.19 lakh million by FY28, and profitability is projected to jump from 10% up to 25%. Operational efficiency is incredibly tight. Return on equity hits 57.3%, and return on capital employed is 76.4%. Even with larger projects, inventory days are on a downward trend, dropping from 83 to roughly 55 days. While some institutional debt metrics aren't fully public, the fact that they are shrinking inventory timelines while entirely self-funding a massive facility expansion proves they are operating with highly efficient, cash-rich working capital. But business health is only half the equation. Ownership structure is the other. The promoters have locked down 51% of the shares, leaving an incredibly tight public float of just 7.22%. This graph tracks institutional ownership over the past year, revealing a tug-of-war. Foreign institutional investors are aggressively buying the float, pushing their stake past 20%. Conversely, domestic institutional investors are actively trimming their exposure down to 21%. Because the public float is so small, this FII buying pressure creates a mechanical squeeze. There simply aren't enough shares circulating to absorb the demand, inflating the stock price rapidly. If you jump into this stock blindly right now, you are acting as exit liquidity for the domestic smart money that is already actively booking their profits. This brings us back to the reality of the current valuation. The stock is trading between 81 and 94 times its enterprise value to EBITDA. This chart illustrates how flawless execution over the next 4 years is required just to bring that multiple down to a normalized 25 times EBITDA. This creates a scenario known as a time correction. The company can continue to execute perfectly, sign every contract, hit every margin target, and the stock price might still stay completely flat for 1 to 2 years, while the actual earnings slowly catch up to the premium you paid today. Paying top-of-the-market multiples means accepting a long period of dead money. You have to decide if you are willing to miss out on other market opportunities while you wait for those earnings to materialize. Let's map this out on a decision matrix based on your timeline and your sensitivity to high valuations. If you are a strict value investor or a short-term momentum trader hoping to chase another 130% spike, you should definitively avoid this. there is no margin of safety left for short-term errors. If you built a position early, securing shares below the 3,000 rupee mark, this is a firm hold. Let that 260 billion rupee order book execute and compound your initial capital. If you have a 5-year horizon and want exposure to the grid transition theme, you accumulate on dips. Do not buy in a lump sum. Expect the stock to consolidate and trade sideways for the next 12 to 24 months. After that time correction, the actual realized HVDC revenue can reasonably support a steady 12 to 15% annualized return. GE Vernova T&D is a hyper-efficient operation, currently equipping over half of India's 765 kilovolt network. It remains essential for the country's energy transition, but to own it today, you are forced to pay tomorrow's perfect price.